I think the calendar range here is something that it's such a simple idea. I mean, it's really just kind of drawing lines, right? And once you know where to draw those lines, it can really help inform you for the next 6 months. So how did you come up with this idea?
Well, Market Gauge and the whole team came up with the idea, so I can't take any real credit for it. But it's really based on a seasonality. So if you want to go shorter term, you can look at a 1 month calendar range, and a lot of people do, which means the high and low of the month is set on the very first trading day of the month. And then you can kind of help with a bias. Obviously, if we're above the high, more bullish, below the low, more bearish. The 6 month, though, is what intrigues me the most, because essentially what it shows is a seasonality of the first half of the year and the second half of the year. And it's not 100%, nothing is, but it's amazing how much information you can get from that. And I just want to say, so I don't forget, the seasonality of an election year is particularly important, and particularly a new administration year. So even if I become a distant memory in your minds by the time we get to January 2025, do remember that that is probably one of the most powerful 6 month calendar ranges you can get, is when you have a new administration. So essentially, here it is that the first 10 trading days of the month, you get a high and a low that is set. And as you just said, Justin, you just draw a simple horizontal line. We depict the high in green and the low in red, right? So very much like traffic lights: green go, red stop. And so there have been years where we have gotten follow through, where we immediately broken out of a 6 month calendar range high, particularly if we're in one trend the year before and that trend reverses into the next year or even into the half a year. And then there have been years where we've broken down into the 6 month calendar range low and have gotten tremendous follow through. And now, so far, as you'll see this year, we're setting up where some instruments have gotten above, and I'm talking about these instruments, not even commodities. I'm talking about the actual indices and some of the more key salient sectors to the economy. Some have broken out, some have not been able to get through, some have not broken down below the 6 month calendar range low, and some have. So that's more information. So all of this is really meant to give you a bias and information. But of course, we always encourage that you use a couple of other indicators as well.
So maybe we could start with, Arusha has kindly drawn some lines here. So maybe we could start with July, and you can talk a little bit about, July 2022. Let me put in the year here. So we can kind of get, this as a case study, and you can kind of tell us how you would be using this. And just to clarify, when you say you look at the month, the first 10 days of the month, you're really talking about January and July, right?
Right. Those are the resets of the 6 month calendar range, for sure. So if we're looking at, and we decided before we got on that we were going to stick to NASDAQ as an example. It's very clean to look at. And what's so interesting is, I know we didn't say we were going to look back at January, but just to give you some perspective of what happened in January of 2022, the 6 month calendar range was set, obviously, early on. It never cleared it. And by the time we got to the middle of the month of January, even before policy started to become very aggressive by the Fed in terms of raising the interest rates, it broke down under that 6 month calendar range low. And that became an incredible resistance point for the rest of the time until we got to July of 2022, where it reset. And so typical of a 6 month cycle that was really in a very strong downtrend, when we got to the second half of the year, and this is actually a really great setup for what's happening in the second half of this year. I didn't even realize it until just this very moment. We actually had the reset in July, where we got the low done right away. The high, we broke out of it as if we were going to continue to go, like the whole thing was going to reverse. And I guess maybe if we had to look at the news back at that time, it might have had something to do with the Fed was done raising. I mean, that's been one of the biggest factors for rallies.
Or inflation being transitory at the time.
Inflation being transitory, exactly. But instead, and this is where we will get talk into phases, we did get that breakout in July over the 6-month calendar range high. And by the time we got to the middle of August, it was clear the rally was running out of steam. It couldn't clear a very key moving average, which is part of our phases. Broke back down underneath that 6-month calendar range high, back under the 6-month calendar range low, and then really spent the rest of the year until the very end of December, when people were really nervous about what was going to happen in 2023, in between that range. And that is also very good information, because if you have clear sailing above it or clear sailing below it, if you're stuck in the middle of it, the information that you should get from that is choppy, probably a good time not to push too many trades, and maybe even a good time to kind of go to cash or look for other types of instruments that are trending. And that's where, of course, you introduced me as a commodities trader. We saw where the NASDAQ chopped around into the end of the year last year. Gold, for example, was actually breaking out. So that's why it's good to use that, not only in and of itself for that particular instrument, but also comparing it to other instruments, what's outperforming or underperforming.
And then, starting at the beginning of this year, you reset the calendar again, and we set the low on January 6th of this year, and then the high,
which was
on
also the
January
follow-through day.
Yeah, and we did have a follow-through day. I didn't want to get into
or the low, I guess. Yeah.
Right.
Yeah,
right.
and so, I mean, that was what made this year, these calendar ranges have been extraordinary, at least the first 6 months of the year, because we had that low put in right away in the beginning of the year. And we know that all the bears came out. But instead, the market reversed, particularly as NASDAQ. And not only did it first clear a major moving average, which we'll talk about again with the phases, but then it cleared the 6-month calendar range high. Then it cleared another major moving average. And basically, except for a little bit of sideways action in even March with the bank crisis that lasted a nanosecond, it never broke down under that 6-month calendar range high. And then, of course, it was off to the races after that banking crisis. And literally, NASDAQ went from, let's call it roughly 300 to the peak that we had so far in our second set of calendar ranges from the July, when it peaked out on July 19th. So almost $100 higher. So, yeah.
Yeah, and I think it's so interesting that on March 13th, it came all the way right down to the top of that calendar high that was set early on. Found support there, and also found support on the 200-day moving average. And that's when, kind of got the market took off at that point, or got more confidence, especially with the whole banking crisis, the quick banking crisis, as you mentioned earlier.
Right. The nanosecond one.
The nanosecond. Yes.
Yeah. And Arusha, I mean, right. So basically what you're pointing out is that old resistance now becomes support, and that you can retrace to the top of that seasonality breakout. And that's a great retracement and a very low risk opportunity to get back in if you miss the boat or you want to add to a position.
Now, you've referred to these market phases a couple times, so I definitely want to have you describe that. But before we do, just one clarifying question. Once January happened and you got your ranges for January put in, do you still pay attention to July at all, the previous ranges, or does that start becoming less relevant?
It becomes less relevant because now you're in a new seasonality.
Right. Okay.
So the only reason why I might look back is to see whether or not there's a consistency that's happening, like what happened in the first half of this year, where last year it was more choppy. I'll look for that and just in terms of a historical pattern, but I will stop looking at it. And now, obviously I'm all about 2023. And even the first 6 months of 2023, we're not really sure what's happening in the next 6 months yet of 2024. And that is also on the basis of the fact that the 6-month calendar range, if we want to just stay consistent and finish it up to where we're at right now, we broke out of that 6-month calendar range again, as I was saying, on July 19th, but we immediately failed it. It becomes a reversal trade, if you will. If something can go through the 6-month calendar range and then fails it, now you know that may be a decent reversal failure. And if you wanted a short, let's say, you could put your stop over the high of the day it cleared. and
Right.
then just sit short. And had you done that in the July, which is why a lot of people say markets don't peak in May, like the sell to May go away, but market peaks actually in July to about the September, the last 2 weeks of September being from a seasonality standpoint, the most difficult markets and often a very bearish market. But in the case of this, if you look at the July low, we did break it in August, and so far in September, we've respected it, the 6-month calendar range low, as we have also respected the high. So now we're back in this choppy range. And so when people say, do you think the market's going to make new highs or do you think the market's going to make new lows? I think it would be really hard on the basis of just that one indicator to know definitively. What we know right now is kind of what we knew at the end of 2022, is we're chopping. Yeah. There will be a major trend change at some point. And why don't you just sort of simply wait for that confirmation rather than sit here and try to guess?
Mm-hmm. Absolutely.
And are you taking volume into account at any time? Because what was interesting was on July 20th, when it broke below the high range, there was a pretty big increase in volume at that point. So not only was it failing, but it was failing with a little bit more conviction.
Yes, that may not be my end all be all decision as I'm just looking at the calendar ranges, but that particular day where people were probably thinking, oh my God, we're going to new highs, new all-time highs. I probably on that reversal would have looked at the volume. That's a great opportunity to say, no, actually the volume was so huge. We had a huge distribution day that turned out in volume and also in the reversal, the actual candle reversal. And then the final sort of nail in that coffin was that it also reversed under the 6-month calendar range high, showing that, we weren't going to go much higher, at least not for a while.
So Mish, you mentioned the market phases a couple times here as you've had as you've been going through these calendar ranges. So what exactly are the market phases that you're looking at?
Well, I'll try to explain them quickly, really more for the essence of them than the actual detail. And my book, as you pointed out in the very beginning, Plant Your Money Tree, A Guide to Growing Your Wealth, is really all about it. Essentially, it's a navigation system for trading. So I like to use 2 simple moving averages, the 50 and the 200 day. You can also do it on a weekly basis and use the 50 and the 200 week. I'll often do that to sort of broaden my time frame and my horizon. But for our purposes today, we can talk about the 50 and the 200. And so essentially these phases, everybody knows about a bullish phase and everybody knows about a bearish phase, and people have different definitions of bullish and bearish. People will say market's up 20%, we're in a bullish phase. Market's down 20%, we're in a bearish phase. But what these do is they actually gauge the 6 phases according to where the 50 is relative to the 200, and then where the price is relative to both of those moving averages. So what really happens is, especially if we put them together with the calendar ranges, is we start to see 2 sets of navigation systems, if you will. One which might be a little bit step back with the ranges, because we're talking about a whole 6-month seasonality range. And then the phases, which can change or stay the same or retrace, and gives you another system of seeing where you are in place and time, depending on what phase it's in. And so I know that may sound complicated, but it's bullish. And then if things deteriorate, you can go like a clock. We go into caution or warning. If things actually start to disintegrate more from that, we go into distribution, which literally is cash getting out of the market. We go into bearish after that. That would be the final phase. And then as we come out, the more positive phases would be a recuperation or recovery phase, my particular favorite. Then an accumulation phase, opposite of distribution. Money starts to get accumulated into the market, and then back into a bullish phase. So it really is very cyclical, doesn't always necessarily follow like a clock, but at least you know where you are at any given space and time.